This is the third class on bond valuation. In the previous class, which happens to be the second class, I said we're going to solve an example on Macaulay duration and modified duration of bonds. I want to ask if you are subscribed to this channel. If you're not subscribed, kindly hit the subscribe button, and after that, share this video with anybody that you know that will find it helpful. Macaulay duration is bond duration, so it's different from N, as in it's different from number of years to redemption. You know what you see in the example where they say a bond trading at 5 naira with 10 years to redemption is different. You see that 10 years you actually see like the coupon period, the number of times they will pay coupon. So Macaulay duration, which is the bond duration, is the average number of years it will take the investor to regain his investment. Right? So the formula for calculating this Macaulay duration or bond duration is what? Let me write it. Bond duration. The formula is what? The sum of weighted present values of future cash flows. I'll explain because we're solving an example now. Divided by investment in bonds. That is the market price. How much did they drop? How much was the bond issued at? Okay. Then the modified duration. The formula for calculating modified duration is bond duration. So you need bond duration to calculate modified duration. Bond duration over 1 plus yield to maturity over N. Very simple formula. A very simple formulae, right? Because there are two. So bond duration, you get your answer in years, okay? And this bond duration is usually less than the number of years for paying coupon. You know, they'll tell you an 8% redeemable debenture trading at 99 naira, redeemable in 3 years. When you say in 3 years like that, if they ask you to calculate the bond duration, the amount of years that the investor would use to recover his money, it will be less than 3 years. Because you're paying coupon in 3 years, doesn't mean it will take the investor 3 years to recover his money. That's just the way you can understand it, okay? So modified duration usually comes in percentage. This one, I said it in the last class, it looks at the sensitivity of the bond price to interest rate. It looks at the reaction of the bond price, the market price of the bond, when interest rate changes, okay? And normally, interest rate and bond price have an inverse relationship, a negative relationship. So when interest rate goes high, the bond price drops. That is very evident when you are trying to discount. This modified duration is just based on the behavior of the market participants. Why am I being dramatic? Okay, let me read the question. When we are solving question, you understand better. Let me read this question on my phone. A 6% coupon bond with 1,000 naira nominal value has 3 years to maturity. The yield to maturity is 10%. Calculate A, Macaulay duration, B, modified duration, and C, the actual percentage change in bond price for a 1% rise or fall in yield. Okay, so let me say that there will be one more bond valuation class after this particular class, this video you're watching. I'll still put out one more video on bond valuation where we will solve like an ICAN question, putting together everything that we've learned in bond valuation. Then we'll now be done with bond valuation and move to the next topic. Okay, so let's solve this question. It said calculate what? The Macaulay duration. You can say Macaulay duration or bond duration. So you need to get your sum of weighted PV. I need to get your investment in bond. The sum of weighted PV of future cash flows means multiplying the present value of future cash flows times the corresponding year. Okay? Then investment in bond is your market value in the bond. Okay? So you're going to have your weighted PV. Now to get this weighted PV, you know you need your PV, right? And present value, know what present value means. It means you're discounting cash flows, right? By particular discount factor. Then you have your cash flows, right? You have your years and you have probably the details, what you are talking about. Year 1, because it said this bond is how many years? 3 years, right, to redemption. So you have year 1, you have year 2, and you have year 3. Okay? coupon in year 1, you pay coupon in year 2, you pay coupon in year 3. How much coupon? 6%. Okay? Look at the nominal value of this bond is 1,000. You know I told you that it could be 100 naira, as in most cases is 100 naira, except if otherwise stated. Here they told you 1,000. Don't go and use 100 naira because they said most times 100 naira. They told you 1,000. So 6% of 1,000 will give you what? 60 naira. 60 naira. 60 naira. Okay? Now, discounting at what? You discount at your yield to maturity, which is what? 10%. So for year 1, what's your discount factor? You know, you won't use an annuity table here. You will wonder why did I not just summarize everything? You will understand when you get to weighted PV. Now why did I not write 1 to 3, 60 and multiply by cumulative cash flow the way we used to do it? It's because of this weighted PV. Because you weight. Weighted PV means multiplying each corresponding year by the PV. Now a discount of 10% at year 1 is 0.909. That one is very common. Year 2, that's 1.1 raised to power minus 2. 0.826. See how we are discounting here? 1 plus r raised to power minus n. This is then 1.1 raised to power minus 3. 0.751. Now you multiply your discount factors by the cash flows. That's when you have present value of cash flow, right? 0.909 times 60. That gives us 54.54. 0.826 times 60, that gives us 49.56. 0.751 times 60, that gives us 45.06. Now the weighted PV is 1 times this, that gives us 54.54. Yeah, right, you multiply by the corresponding year. 2 times this, that's 2 times 49.56. That gives us 99.12. 3 times this. 3 times 45.06. That gives us 135.18, right? So also in year 3, there will be what? Redemption. Redemption. And they say you are redeeming at. There will be redemption. And they say you are redeeming at par. Okay? So that's 1,000 at par to the nominal value, to the par value. So year 3 is also 0.751. But you can just say 1,060 and multiply. But you can spread it out, okay? So just to understand what's happening. So this times this, 1,000 times 751, you have 751. Right? So you multiply it by 3. That's you're weighing it 3 times 751. That gives you 2,253. 2,253. So you add all of this, sum of weighted PV. That's what you have here. Okay, so you add all of this. 135.18 plus 99.12 plus 54.54. 2541.84. Okay? 0.84. So this is the sum of your weighted PV. This one that you're looking for. Okay, so just put it there. 2541, right? 0.84 divided by investment in bond market value. Don't forget formula for market value. Sum of present value of future cash flow. See this one here. Present value of future cash flow. Just add what is here. You know this weighted is a new thing here now. Okay, so add it up. That's 4.54 plus 49.56 plus 45.06 plus 751. That's 900.16. So you have that 900.16. See, average time required for the investor to recover his original investment. This investor drops what 900 is buying this bond, a bond of 1,000 at 900.16. So once we are trying to get the time to take when to recover this money, okay? So 2541.84 divided by answer, that gives you 2.82 years. So it doesn't actually take him 3 years, like the question said. It takes him 2.82 years to regain, or just 2.8 years to regain his investment. So the fact that you're paying coupon for 3 years doesn't mean that the investor will actually wait for 3 years to regain his investment, okay? Yeah, so let's go to the B part of the question. So the B part of the question says calculate the modified duration. Modified duration. And I told you modified duration is in percentage. It looks at the sensitivity. That is how sensitive is the bond. That is how sensitive is the bond price. This investment in bond, the market value of the bond, how sensitive it is it to the interest rate. Okay, so this is the formula to use. So the higher the percentage, and the higher it is, the higher the percentage, the more sensitive the bond is. Okay, so this modified duration is bond duration, which will go to be 2.82 divided by 1 plus, what is your yield to maturity? 10%. Okay, 10%. That's 0.10 divided by number of years. That's 3. This n is coupon years, different from the bond duration. Sorry, that's 3. Okay, so let's put this in our calculator. This kind of fraction, if this is how to do it in your calculator, start from here. This one, this one to this one, then you do the whole thing. So 0.1 divided by 3. You've gotten 0.0, then plus 1. You've gotten something. They say 2.82 divided by answer. Okay, so this is 2.73%. See how sensitive your bond is, right? It means that for every 1% increase in interest rate, that interest rate is what your yield to maturity, bond price will increase by 2.73%. Does it make sense? So for every 1% decrease to an interest rate, for every 1% increase in interest rate, bond price will decrease. It will reduce by 2.73%. Because there's an inverse relationship. As interest rate is increasing, bond price is decreasing. So it means for every 1% decrease in your interest rate, bond price will increase by 2.73. You know what? There's a C part of the question now. The C part says calculate the actual percentage change. Let's do the C part. It said what is the actual percentage change in bond price for a 1% rise or fall in yield? Yield is the interest rate. Okay. So let's do the rise first. So rise by 1%. That is if interest rates rise by 1%. What is interest rate now? Interest rate now is what? 10%, right? This one. So if it rises by 1%, it's going to become 11%. Now, it means let us calculate the bond price with this 11%. It means let us discount it 11%, right? And see what we get. So if we discount it 11%, it means that these discount factors here will change, right? They will change. Can you imagine, you guys? That thing wasn't recording. It was not recording, and I was solving. So I said when it rises by 1%, you have 11%. So you now start discounting at 11%, okay? So you have 1 plus 11% raised to power minus 1. That will give you 0.901. 1.11 raised to power minus 2. That will give you 0.812. 1.1 raised to power minus 3. That will give you 0.731. Now you start multiplying by your coupon. Okay? In year, this is year 1, year 2, year 3. I've actually done all of this, but my camera was not recording. I just realized now. Because I got the call, so I paused it. And then I forgot to play it, and I just continued talking. So in year 3, it's just like you say 1060 now. 1000 plus 60. Since we are multiplying by the same discount factor. Do you understand? So, as I multiply this by this, you get 4.06. 60 times 0.812, you get 48.72. 1060 times 4.731, you get this. See, all these things just trying to show you the relationship between interest rates and bond price. Now, you that bond price has gone lower than 900.16 because interest rates went up. This is like common sense. What we've been doing all along, if you discount by a higher price, the market value will drop, right? percentage change in bond price if this interest rate rises by 1%. So look at the change. This is the change in bond price. 900 minus 900.16 minus 877.64 over 900.16. You guys know how to calculate the change now. Delta, this thing, the total when we're in like GS3, change, you know, the old, just like old minus new over old. You want to say by how much did your profit for the year increase? What was the profit before? Minus what is the profit now? Divided by what the profit was before. Okay, so that's what they are saying when they say you should calculate percentage change. Okay. So we have, let me do that. 0.16 divided by 900.16. So you have 0.025, that's 12. That's 2.5% change. Okay, that's a 2.5% decrease. This is how you put your answer. A 2.5% decrease. Now they said for a fall, if it falls, you can predict your answer now. If it falls by 1%, it means the interest rate is becoming what? 9%. So they are saying you should discount those cash flows by 9%. Okay, so it's the discount factor that will change. It will now be 1.09 raised power minus 1, 1.09 raised power. Please, if you have any questions, ask in the comment section. 0.917, 1.09 raised power, 1.09 raised power minus 2, 0.842, 1.09 raised power minus 3. Since so annoying here. But the way you can be fast is by solving questions, because time is always a limiting factor. Now you multiply by your cash flow 60, 60, 10, 60. This is redemption and coupon of the third year. That's why you have 10, 60. So 60 times. Okay, let me just do this in the right calculator. Here you have 8.5. 60 times 0.842. We have 50.52. 60 times 0.917. We have 55.02. So let's add up to get the bond price, the market value of the bond. Okay, plus 50.52 plus 818.5. That gives you 924.04. Can you see? 924.04 is higher than 900.16 because when an interest rate falls, the bond price will go up. So what is the percentage change? Just like what the question has asked for. That's what 900.16 minus 924.04 over 900.16. Okay, so let's do that. Divided by 900.16, 2.6% increase. So the bond price increased. So the bond price increased by 2.6%. Here they are approximately the same. Okay, let's say that all these approximation. But aside from these discount factors, that's where the old decimal is going to be the same thing. But I mean, it's the same. Even to 3, it's still the same. So you can see that there was an increase when the bond price fell by 1%. So what it's just trying to describe to you is this modified duration. If it was a zero coupon bond, it would have made more sense in the explanation. But just know, I don't want too much explanations that will now make us confused and all of that. Okay, because even me too, I did not really get all these things in class. And even as I'm teaching it, so I'm getting to understand it better. Do you understand? So just find your own way to understand it. So there's one more class after this one where we're going to solve this big question. Let me even put it on the screen now so you can screenshot it and now be rehearsing it down. The name of the question is it's kind of long, but it's not that hard. The name of the question is Point Limited has a cash surplus of 20 million, blah blah blah. So this one is like a 20 marks question, and we'll solve it in the next class, which will be the 4th class, which will be the last class on bond valuation before we move to investment appraisal. Thank you guys so much for watching, and Don't forget to give my video a thumbs up, and I'll see you in my next video. Also, let me know in the comment section if you found this video useful. Let me know if you have questions. I'll be ready to answer your questions and respond to your questions. Thank you, and I'll see you in the next class. Bye.